everybody, and welcome to our first sustainability webinar for 2026. And in this webinar, we're looking at sustainability reporting in 2026, what's changing and what's expected. Now, we've got a few changes, or a couple of changes for 2026. First of all, you are lucky enough that you will not have to listen to only me this year. I've got some fellow presenters that will be joining me. I feel as if the attendees have been long suffering listening to only me for a number of years. So I'm very excited to welcome Claudia, Ramona, and Natalia, who are all senior managers in our sustainability reporting team in Melbourne. So excited to welcome them. We will take turns to present during the year. It would usually be me with one of them or all of them or a combination of them. So good morning, Claudia, Ramona, and Natalia, and welcome to our sustainability webinars.
Thanks, Lauren.
BDO acknowledges the traditional custodians of country throughout Australia and their connections to land, sea, and community. And we pay our respect to their elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islander peoples. Now, you've registered for the first one, but we want to flag that there's 12 for the year, one every month, usually the last Wednesday of the month. And this is an overview of the schedule for the year. So in January, we're looking at what's changing and what's expected. In February, we're looking at making the case for sustainability. Why should CEOs and boards care about sustainability, including sustainability reporting? And then basically for the rest of the year, we go back to our now beloved AASB S2 Climate-related Disclosures, and we try and unpack and help you to get ready for mandatory sustainability reporting. Now, some of you are Group 1 clients or entities, and you are getting ready to report. Maybe you've had this 31 December year end. You are getting ready to report, maybe a March year end, maybe a June year end. So this is very relevant for you. What do you have to do to get ready for mandatory reporting shortly? If you are feeling that there are topics that we're discussing later on the year, but you actually need it now, you can go back to our recorded sustainability webinars from previous years, because in 2025 in particular, we covered most of the requirements of AASB S2. We are revisiting all of those, mainly for the benefit of Group 2 and Group 3 entities. Then we also do monthly IFRS and corporate reporting webinars. Now, the big thing in IFRS world at the moment is the new IFRS 18, looking at the format of your profit and loss. So quite a bit of changes to the presentation in profit and loss, or your old income statement. So you can see we've scheduled a number of webinars unpacking IFRS 18, if that's of interest to you. We are also very proud to announce, and it actually is going out on the website today, that BDO is partnering with the Financial Review and to present Sustainability Leaders. So it is, we've partnered with Australian Financial Review. We are the presenting and the methodology partner for the 2026 and 2027 Sustainability Leaders Program. And through that program, the AFR and BDO are trying to recognize organizations delivering measurable sustainability impact. So if you want to find out more about that program, BDO's role, and in particular, whether your organization could be an entrant into that competition, please do so, and there's a link for you. You can read all about it. Very proud to work with the AFR on this. Then we have last year recorded a number of short videos, Sustainability Essentials for Financial Leaders or Professionals. It's available on the Quitch platform. I think a nice thing about this is a lot of board members, executives, or broader staff members in some of our clients are asking, how can we learn about sustainability? Short, sharp, 5 short videos. We get CPD credits for it, and it gives us a good baseline understanding. Then we also run our quarterly carbon accounting masterclasses. It's a virtual masterclass, and the dates for 2026, and the first one on the 11th of February, so quite shortly, believe it or not. You can register using that green button, and we would love for you to register for any of these carbon accounting masterclasses. It's a full day carbon accounting masterclass, 9 to 5. You receive our BDO Global Carbon Accounting Methodology, which I guess is around 200 pages. You get access to 26 case studies, as well as the solutions, and obviously all the PowerPoint slides, and I'm presenting those masterclasses. Now, for those of you who have in the past attended our carbon accounting masterclass, we've created an alumni group. And the reason for that is you might have attended the masterclass 3 months ago, 2 years ago, and things have changed, and things are constantly changing. And therefore, we want to circle back to you and provide an update on changes since you've attended the carbon accounting masterclass. So this one is complimentary. It's only for people who have previously attended the carbon accounting masterclass. So this is a quarterly top-up on latest developments. Again, the dates available. The first one is already on Monday, the 9th of February. The other thing that we've got available to help you to get ready for mandatory sustainability reporting, we've got a AASB S2 disclosure checklist, 150 disclosures, where you can do a self-assessment to what extent you're ready to do the disclosures. We can also help you to do that, and we are actually more interested in helping you address the problems after you've had a look at that checklist. In the checklist, it's not just 4 pillars in Australia, it's the normal 4 pillars: governance, strategy, risk management, and metrics and targets. But also, in order for AASB S2 to work, we need some paragraphs from AASB S1, 31 of them, and they've been included in Appendix D of AASB S2. So AASB S2 is a standalone self-sufficient standard, and we've just embedded those paragraphs that we use, and you also have to comply with them. They are mandatory paragraphs. In December last year, BDO Global, together with BDO Australia, our team worked on this, published our model accounts, or our illustrative sustainability report. There's a link there where you can download this illustrative sustainability report. So there's a disclosure checklist, and if there are gaps, there's also illustrative sustainability report. Very important, your illustrative sustainability report should be read together with our illustrative financial statements, because the two of them sit side by side, and that's also how it will be for your organization, sitting side by side within your annual report. So quite a lot of resources, training opportunities, collaboration opportunities available for you in 2026. I also want to say, if there are any specific needs, ideas, please feel free to reach out to us and we consider that. Now, earlier, I said we're making a couple of changes to the webinars this year. The first one is it's not just me. We've got 4 presenters. The second one is at the end of every webinar, we'll also have a Q&A session. Unfortunately, with the technology, a live Q&A is not possible. So what we've said is, as you register for the webinars, there's an opportunity to log questions if you've got particular questions on your heart. And in the webinar, we will address each and every one of them. Also, during this session, you can log questions. It's hard for me to access that while I'm presenting and respond, etc. So what we'll do at the end of the webinar, we'll take all those questions you've raised and either address it in next month's webinar in the Q&A session, or we'll include it in an article in our corporate reporting insights that go out every month, or sustainability news. So that's the two, I would say, new things for 2026. Latest developments. As you know, we always start these monthly sustainability webinars with the latest developments, because we try and come up with the topics we think is suitable, but then things happen and we have to discuss them. If you've missed our December 2025 webinar, please go back and watch the recording. You can get it on our website as well as the PowerPoint slides, because there were slides and slides and slides and slides of latest developments, which I don't have the time to repeat today. So please make sure you've considered all those latest developments. But for today, I think big news is on the 21st of January, so only last week, the Australian Auditing and Assurance Standards Board issued illustrative Corporations Act sustainability assurance reports and audit reports. So really important that you can look at those illustrations. On the right-hand side, they've got 4 illustrations. So the first one is for year 1, where we have the auditors doing a review report of specified sustainability disclosures prepared in accordance with the Corps Act. So it's a compliance framework. To what extent did the client comply with the specific requirements? So they only look at certain of the disclosure requirements. They don't have to express a conclusion on everything. The second illustration is where there is an audit and a review report of these specified disclosures. So an example would be, some clients would say, I want an audit of my scope 1 and 2 emissions, and that is going above and beyond the mandatory requirements, but I want a review of the other items. So how does a report look like where there's an audit opinion and an assurance conclusion? So that's the other illustration, illustration 2. Illustration 3 is looking at years 2 and 3 for your organization. So that is where in years 2 and 3, we need a review report on a sustainability report that is prepared in accordance with the Corps Act. But now it is all the requirements of the Corps Act and all the requirements of AASB S2. So it becomes a fair presentation framework. So in year 1, it's just complying with the specific requirements. In scope 2, does it give us fair presentation? We look holistically at AASB S2 and the Corporations Act. And then an illustration for year 4 onwards. This is where we need an audit of the sustainability report, and that will also be a fair presentation framework. When you look at these illustrations, year 1, year 2, year 3, year 4 means your entity's first year, second year, third year of reporting, which will obviously be later for groups 3 than for our current clients reporting under group 1. So there's a link to the Auditing Assurance Standards Board website. You can look at all these illustrations, and these are snippets that I wanted to flag with you. On the next few slides, you can see a little bit of an extract on that illustration 1. So that is the report we expect for most entities in the first year, where there is a review conclusion on very specific disclosures, some on governance, a few sub-paragraphs on strategy, risk and opportunities, and then also scope 1 and 2 emissions. So here you can see, what does the review conclusion look like? We have conducted a review of the following specified sustainability disclosures in the sustainability report of ABC Company for the year ended, let's say, 31 December 2025, as required by ASSA 5010 under the Corporations Act. And it's issued by the Auditing and Assurance Standards Board. And there you can see a list. These are the specified disclosures that the auditors are expressing a review conclusion on. So if it's a review, it's a conclusion. If it's an audit, it's an opinion. So here it's just a review, it's a conclusion. And then they say, you can see in the little block at the bottom, we have not become aware of any matter in the course of our review that makes us believe that the sustainability disclosures specified in the table above do not comply with Division 1 of Part 2M3 of the Corporations Act. So it is a conclusion, it's negative assurance, nothing, it's we've not become aware of anything. So that's the kind of report we're expecting to see. Then I just want to flag this as well. Lower on in the report, don't overlook this. There's a paragraph on other information, and this is important because all the other requirements of AASB S2 have to be included in your mandatory sustainability report, with the exception of Scope 3. So what about all that other information in the mandatory sustainability report? What would auditors do about those? Now, here they explain in this report, the directors of the company are responsible for the other information. And the other information comprise, and then they describe the information. So everything required by AASB S2, strategy, risk management, metrics, and targets. Our conclusion on the specified disclosures does not cover the other information, and we do not express any form of assurance conclusion on the other information. However, in connection with our review of these specified sustainability disclosures, our responsibility as auditors, assurance providers, is to read the other information identified above, and in doing so, consider whether the other information is materially inconsistent with the specified sustainability disclosures, or our knowledge obtained when conducting the review, or otherwise appears to be materially misstated. If, based on the work we've performed, we conclude that there's a material misstatement of this other information, we are required to report that fact. We have nothing to report in this regard if they haven't seen anything. So you can see, in a very subtle way, the auditors will look at all the disclosures around AASB S2, and if there's anything in there that they think is a material misstatement, although it's not the scope of their assurance, they have to report that. Now, in practice, and Claudia and Ramona and Natalia will agree with me, in practice, when we do advisory work and there's assurance being provided by other firms, including, BDO firms as well, we know that they are not just asking our clients and us for information about governance, climate risk and opportunities in Scope 1 and 2. The auditors are actually asking for all the information, all the supporting information. And it's because of this paragraph. They have to read it. They have to assess whether it's materially misstated or not. So I think it's important to just read that paragraph a number of times, and many of you would already experience that in practice. Then they also talk about responsibilities for the specified sustainability disclosures. They make it very clear the directors are responsible for the preparation of the disclosures in accordance with the Act, and the directors are responsible to design, implement, and maintain internal controls necessary to enable the preparation of this report. That's the job of the directors. It's similar to what we see in financial statements. In an audit report over financial statements, these are the responsibilities of the directors, these are the responsibilities of the auditors, and then obviously there's an opinion. So I think it would be worth your while to have a look at those illustrations. So that's the first new development. The second thing, as you know, in Europe, there's been a lot of activity. So the European Parliament have approved simplified sustainability reporting and due diligence rules. So finally approved. It's taken them a while. It's captured in Omnibus 1. There's a link to an article by BDO Global on that. So if you look at the simplified sustainability reporting and the reduction in scope, only EU companies with over 1,000 employees on average and a net annual turnover exceeding 415 million euro will be required to report on sustainability. So they've really raised the bar really high. They also said, and I think that's more important for our Australian entities, is the same turnover threshold of 450 million euro generated within the EU will apply for non-EU companies and to their subsidiaries and branches generating net annual turnover of over 200 million within the EU. So I think that's important to have a look at that. Sector-specific reporting will be voluntary, similar to AASB S2, where we don't have sector-specific disclosures. And then smaller companies with under 1,000 employees will be protected from being required to provide additional data beyond the voluntary set of sustainability disclosure standards. So they've got a voluntary standard for SMEs, and that's a requirement that could potentially be mandated. So there's some protection against that. And then also the EU will launch a digital portal offering templates and guidelines. So they're really trying to water down the quite extensive European sustainability reporting standards. At the moment, the watered down European sustainability reporting standards are closer to IFRS S1 and S2. In the past, European sustainability reporting standards, there were 12 of them, were way above. So I think there's more alignment as a result of this. There's also adjustments around corporate due diligence. Due diligence obligations will apply only to EU companies with over 5,000 employees and net annual turnover of more than 1.5 billion euros. So some information about that for you as well. Then I wanted to flag with you that BDO Global has published our 31 December 2025 sustainability reporting update. There's a link to that update. In that update, there's an update on what's happening in Europe, Australia, Japan, all the different countries, GRI, TNFD, etc. So very good roundup if you want to have a look at that, especially outside Australia. The other thing that I wanted to talk about is the task force on nature-related financial disclosures. The International Sustainability Standards Board, that's published IFRS S1 and S2, have at their December meeting in 2025 decided to officially put on their work plan the development of a IFRS S3 based on the requirements of the task force on nature-related financial disclosures. So looking at nature, I think the title at the moment is around biodiversity, but that will be IFRS S3. They've done a lot of research and now it's officially on the work plan. And they've also said they expect that very shortly, officially on their work plan, will be the development of an exposure draft for the workforce, IFRS S4. Just coming back to, TNFD, they will be basing IFRS S3 on the TNFD disclosure requirements, similar to how IFRS S2 was based on the TCFD. So you can see the TNFD have similar pillars. We've got governance, strategy, risk, management, metrics and targets. They call it risk and impact management, but you can see similar 4 pillars, similar high level recommended disclosures at the moment, but this will now be codified into IFRS S3. I've listened to a podcast where the deputy chair of the AASB said they expect an exposure draft during 2026. Now, usually There will be an exposure draft, usually quite significant period to provide feedback. Then it will turn into a standard. So I'm guessing now, let's say a standard in 2027, and then usually an implementation date or recommended implementation date another year or two further. So I'm thinking we're looking at 28, 29, and then Australia has to decide whether we're going to adopt it and mandate it in Australia. And I think the Australian government has made it clear that they want to focus on climate first. They want to focus on making sure AASB S2 is well embedded in for group 1, 2, and 3 before they add additional standards. But that's a possibility, and they moving fast ahead. The other thing I want to touch on is the BDO Global Sustainability Survey. And many of you have been kind and have completed the survey, and we really appreciate that. So we wanted to share some of that. So first of all, you can look at the report, which was finalized in October, which you can download there, but a few key things. So one of the positives that we've seen out of the survey, and it was a global survey, but a lot of participation from Australia, so just thank you again. But positives, sustainability remains in focus. 87% of companies include sustainability in their business strategy. And companies are clearly motivated by the need to run sustainable businesses. So that's fantastic. The second thing is sustainability creates business value. 83% of respondents view sustainability as a competitive advantage, motivating increased or at least stable budgets and continued reporting despite political or regulatory setbacks. And these regulatory setbacks is like talking about what's happened in Europe. Many entities in Europe, because they see the competitive advantage, they continue to do reporting. And then budgets, sustainability budgets are largely intact. So those entities haven't lost budgets despite trends towards deregulation and regulatory delays in Europe and obviously in the US. On the right-hand side, some of the negatives. There are cost and investment barriers, and that's the top challenge globally. Alongside regulatory uncertainty, especially for smaller companies, it adds complexity. So we have a regulatory certainty in Australia, but we do have cost and investment barriers. Then also a negative, developing the business case and regulatory changes can be a hindrance for some companies. And we're going to talk about developing that business case for CEOs and boards next month. And then also resource constraints. So smaller companies struggle with limited resources and expertise, and making it hard to implement sustainability plans effectively. So 83% of respondents say that sustainability provides a competitive advantage, yet only 25% of these companies have a mature sustainability program. So I think there's a lot of work to do. And then on the right-hand side, you can see we've looked and asked for the top challenges when implementing a sustainability strategy. And if you look at Asia Pacific, obviously where Australia sits, the highest challenge, cost and investment barriers, and then regulatory and compliance complexity, as well as insufficient resources, change management, internal resistance. Yes, we see that. And finally, short-term pressure versus long-term goals. And I think that's all very valid, what we're seeing in the market. And then some regional insights, some quotes that I've provided to the report. And you can see the countries participating were Australia, China, India, Japan, the Philippines, and Singapore. And then in Asia Pac, we are leading the way on mandatory sustainability reporting. So you can see 47% of respondents have published a sustainability report. This is a voluntary sustainability report, which is a bit lower than Europe. 36% of respondents are primarily focused on compliance because we've got mandatory regulatory requirements. And then 31% are integrating sustainability into business operations. So a bit of an overview of what we've seen from our global survey, and the report was published in October. So what's changing in 2026? Earlier this month, I've published an article, or we've published an article that I've written in the Accounting Times, and it was the reporting evolution that's accelerating into 2026 in Australia. And we said, in 2024, that's when sustainability reporting gathered momentum in Australia. And 2025 was the year that it became part of mainstream reporting. So yes, in 2025, the foundations were laid, but in 2026 is really the year where businesses will start building structures that sit on top of those foundations, because mandatory annual sustainability reporting is now a thing, and we have to get ready to do that more efficiently and effectively, not just building the foundations in year one, but how do we repeat it going forward. So that's an article that you could have a bit of a look at. So what's changing? So what's expected? Now, this I'm going to do really fast, and this is a recap. For those of you who are attending the webinars for the first time and don't know whether you are Group 1, Group 2, or Group 3, and therefore what that means for mandatory sustainability reporting, believe it or not, we still get this question. Are we Group 1, 2, and 3? When do we have to report? When do we have to start? So there are 3 criteria. Criteria 1, the size threshold. If you meet that, or if you meet criteria 2, or if you meet criteria 3, you could fall in a particular group. If you look at criteria 1, the size threshold, if you meet 2 of the 3, you will meet that criteria. So that's a bit of an overview. Very important, and I just want to highlight this again. The threshold question, if you are new to this, the threshold question is your entity lodging a financial report with ASIC as required by Part 2M of the Corps Act? So if you have a group of entities, the first question is, which of those entities are lodging with ASIC, and why are they lodging with ASIC? If they're lodging under Part 2M because they are large, private, disclosing, listed, etc., they are within this regime. If they are lodging under Part 7 because they have an AFSL license and that's the only reason they're lodging, they are not within this regime. So that's the first thing. The second thing is, if you've got a group with subsidiaries, they're trying to make it easier for subsidiaries to not have to do their own sustainability report. So it's not like financial reporting. It's not about having deeds of cross guarantee in place. It's got nothing to do with that. And you don't have to meet the class order requirements. It merely is the entity that you're looking at a subsidiary whose ultimate Australian parent prepares and lodges a consolidated sustainability report with ASIC? And if you say yes, that subsidiary still have to lodge a financial report with ASIC, but they don't have to do a separate sustainability report. This is a bit of an overview of the previous slide and how the different criteria work together to work out whether you are scope 1 or whether you are group 1, 2, or 3. Reporting timeline. If you're Group 1, it's for years beginning on or after 1 January 2025. Group 2, years beginning on or after 1 July 2026. And Group 3, years beginning on or after 1 July 2027. And we've got a table explaining that a little bit more. Really important to know that there are special rules from an assurance perspective for Group 1 entities where their years started between 1 January and 30 June. So it's only for Group 1, it's only if their years have started between 1 January and 30 June. So for example, if we've got a Group 1 with a 31 December 2025 year end, and the special rule for them is that they've got 2 years where they have limited assurance over only a small number of things, 3 things. And then they go to another 2 years of limited assurance over everything. And then only by 31 December 2029, their 5th year of reporting, do they need reasonable assurance, so normal audit. So that's a special rule for those Group 1 entities. Your other Group 1 entities, where their years begin between 1 July and 31 December, you can see they don't have that long runway. They have 1 year of limited assurance over only 3 things, 2 years of limited assurance over everything, and then reasonable assurance in the 4th year that they're reporting. So special rules there. Now, what we've previously done is we've flagged with you a best practice roadmap, and recently we've tweaked it a bit. And our best practice roadmap for Group 1 entities, we've got 3 project streams. The one is on carbon, the other one on the rest of AASB S2, and the grey one is grey out, it's voluntary, is AASB S1. So if you look at mandatory reporting, it's the top 2 streams. Each one have 5 projects in that stream. And the one that we've tweaked in project stream 2, we've added establish or improve appropriate governance and risk management structure. We've added that at the start of that project stream. So you can see there's now 5 projects in project stream 1, 5 projects in project stream 2, together 10 projects. In red, I've marked the projects that will be explicitly subject to assurance, but all the other projects and the outcome of the other projects will also be subject to the auditor having a look at it. The only exclusion, obviously, there is scope 3, because we only include scope 3 in the next year. And then targets, you're not forced to set a target, but you could potentially set a target already in your first year. A little bit slower for Group 2 entities, and I've put a red block around strategic focus, because sometimes Group 2 and Group 3 entities are saying we don't have to do mandatory reporting, but strategically, you know, it's time for us to do something because our clients are asking for this information. We thought it's a good idea in the 25 minutes left to give you a bit of a run over very high level of project streams 1, 2, and 3, and the different projects in that, because people often say, Aletta, you've got the proposed roadmap. What goes into each one of them? What do you do within each one of them? So Claudia will be looking at project stream 1 around carbon accounting. Over to you, Claudia.
Thanks, Aletta, and thank you again for having me. So project stream 1, carbon accounting, it's definitely forms part of the metrics disclosure within your sustainability report, but we separate it out because it's subject to a different set of measurement frameworks, and it therefore deserves its own attention to make sure that you are ready for assurance at the end of the process. So project number 1 is develop a boundary setting policy. For those of you that aren't new to the webinars, you will have heard about this before. So rather than going through exactly what that involves, we wanted to answer some of the questions that we're seeing come through. So in terms of the key things that you need to consider when you're developing a boundary setting policy, the first one is the consolidation approach. So in the same way that you need to consider which businesses need to be consolidated into your financial reporting entity when you're preparing your financial statements, the same process applies here. So there are 3 consolidation approaches, and you need to be able to justify why the one you've selected is appropriate for your business. That can be done in a local context based in Australia. It can relate to the global context, whether you have a parent entity or operations overseas, but it's important that you select the right one for your business. When you do that, you then consider the whole group structure, all of your investments, your subsidiaries, all of your different connections within a group entity that you're operating. So when you do that, it's important that it is complete and it's documented appropriately so that you can then show your assurance provider, your auditor, the process that you've gone to identify what your organisational boundary is. Once you've done those steps, the operational boundary, step number 3, if you will, is to then classify all of the different sources of emissions within that operational, the organisational structure that you've defined. So making sure that you're not missing any product streams and that you are really capturing all of the different sources of emissions. to make sure that your policy is as complete as possible. It's really important that you consider your whole value chain at this step, because if you try to limit your policy to scope 1 and 2, it means that you might miss things which will cause issues down the track. So the key thing to note here is always, always, always focus on completeness, which is a key word that I know that everyone who listens to webinars is very used to hearing. So that's the boundary setting policy, project number 1, where it all begins. Project number 2 then takes the boundary setting policy to develop a basis of preparation for actually then going through scope 1, 2, and 3. And the reason it's important to go through scope 1, 2, and 3, again, just like with the boundary setting policy, is to make sure that if a source of emissions isn't captured in scope 1, we know exactly where it does go for completeness purposes. So a key question that we get is what goes into this basis of preparation? And I think logically, what an auditor will expect to see in your basis of preparation is a description of the source of emissions that you need to measure. So for each different source of emissions, there should be a section addressing that source of emissions, a description of the activity data that you're using. And this is really important because obviously internally you want to be able to efficiently repeat this process year on year or more frequently, depending on your needs. And then you need to be able to appropriately assess the quality of that data. So the Greenhouse Gas Protocol gives us 5 quality indicators: reliability, temporal appropriateness, geographical appropriateness, technological appropriateness, and the most important, completeness. Again, a theme, our favourite theme, if you're listening to webinars regularly, that data quality assessment is absolutely critical, because if you compare it, or if you follow your organisational boundary, you'll be able to see whether you have any data gaps that need assessing or addressing. And all of those data gaps, whether it's the fact that you can't collect data for a certain entity, or you've never collected data for a certain type of emission before, that's exactly the kind of issue that process helps you identify where you need to allocate your resources next. So those gaps or to address those gaps, sometimes you can make assumptions, sometimes you need to estimate, perhaps using extrapolation. But for a lot of the people on the call who are chartered accountants, it's a good thing that we are in the business of making reasonable assumptions. And so for that reason, once you've gone through that data quality assessment, you're often really well equipped to apply the tools in your toolkit to fix those data gaps. Once you've done that, that's when you can then clearly articulate how your measurement is actually going to occur, which measurement methodology you're selecting, and how you're applying it to your activity data, and also confirming which emission factor database you're using and which emission factors you're applying. So that's your basis of preparation in a nutshell. And all of those things come from the Greenhouse Gas Protocol and AASB S2. So then when you actually measure scope 1 and 2, you already have, or you're equipped to do that really effectively, because you know exactly what to do based on your basis of preparation. With scope 1 and 2, it is subject to assurance and reporting from year 1. So it is important that if there are any data gaps identified, there is a strategy to improve your data quality over time. In terms of scope 3, it's understood that there'll be the largest data gaps here. There is 1 year of relief from a reporting perspective, and then also from assurance. But while it is possible to measure scope 3 at the same time as scope 1 and 2, we usually find that it's more effective to measure them sequentially. So then when you have a full carbon footprint, scope 1, 2, and 3 has been measured and documented in your basis of preparation, you can also then choose to set targets. Setting targets is not mandated by AASB S2. However, when you choose your strategy for disclosure in mandatory sustainability reporting, it's important to note that even though not setting a target releases you from certain target setting disclosures under paragraph 33 and 34 of the standard, it's really important to consider the market perception of that non-disclosure. So some entities will calculate scope 1 and 2 and consider the best way to minimise those scope 1 and 2 emissions, and therefore set targets over those, and then perhaps choose to revisit scope 3 targets later. But it's really important that all businesses understand that when these mandatory sustainability reports are published, they will be accessible to many more stakeholders than they've ever been accessible to before. And on that note, Aletta, I might hand back to you for work stream 2. Oh, before we get there, sorry, assurance expectations. So at the end of that process, from your boundary setting policy, basis of preparation, scope 1, 2, 3 measurement and target setting, what is your assurance provider going to be most interested in? And the answer is that when they review your boundary setting policy, they're going to want to know how your reporting entity for greenhouse gas emissions measurement purposes compares to your financial reporting entity. So having that strong organisational boundary comparison and documentation is going to be really important for this step. And making sure that if there are differences, those are justified and documented accordingly. In terms of the basis of preparation, there is a difference between, or there are some differences between the greenhouse gas protocol measurement principles and what is required for AASB S2. So making sure that AASB S2 requirements are appropriately considered when preparing for your mandatory sustainability report are going to be critical to your assurance provider. If you're interested, or if you are an ENGA reporter, the basis of preparation is the most appropriate place to document which measurement you're leaning on from an ENGA reporting perspective, and what aspects of your measurement you have to top up in order to be compliant, not just with the greenhouse gas protocol, but the incremental requirements of AASB S2. So if that's applicable to you, that's going to also be a critical aspect of your audit. And then in terms of actual measurement and the activity of calculating, crunching the numbers, making sure that those are reconciled to financial data and making sure that in accordance with the boundary setting policy that your business has created, it's complete. That's going to be a key area of focus. All of the arithmetic accuracy per usual when financial statements are reviewed as well.
Thank you very much, Claudia. Looking at project stream 2, where we look at climate-related disclosures or the other climate-related disclosures, because absolutely the carbon footprint that Claudia talked about is part of metrics and targets, it's part of the report. But all the other things, we look at governance and risk management. It's the new project we've added. Let's start there, make sure we've got governance processes in place. Let's make sure we've got a risk management framework, a risk register, risk appetite, all of that in place. And you know, if we look at this part, for governance, there's only 9 disclosure requirements. For risk management, only 9 disclosure requirements. So we are heavily guided by what those disclosure requirements are. And this is from our AASB S2 checklist. So we really look at, this is what we have to disclose. Do we have it in place? If we don't have it in place, let's create it. Or it is in place, but it's not been updated. Let's help you to update it and get it ready for assurance. So those are the 9 disclosure requirements around governance, and there's another 9 disclosure requirements around risk management. Risk management links to the next project. In order to do your climate risk and opportunity assessment, we use your risk management framework, your guidance on how you assess likelihood, consequence, your risk appetite. So we look at governance, we look at risk management. That leads us to the next project, project 7 altogether, and that is to conduct a climate risk and opportunity assessment. This is the absolute foundation of everything we're going to do within AASB S2. AASB S2 is focused on climate-related risks and opportunities and disclosing those. So we have to start by looking at what are your climate risks and opportunities? Have you picked up everything? And how we look at it is we consider the climate science and we consider climate policies. And climate policies, not just where you are located in Australia, but across your value chain. Climate policies where your customers are, also your suppliers. The same with climate science, the physical risks. Maybe suppliers are subject to physical risk, but you in Australia are not subject to physical risk. So we have to look across the whole value chain. And we're looking for physical risks in particular. So that's where we've got changing climate conditions, extreme weather events. In Melbourne yesterday, 45 degrees. It was sweltering. Transition risk, that is policy changes, which we see in Australia, mandatory reporting, target setting. We see technological innovation. We see social adaptation, and all of that is businesses transitioning to a low carbon or a low emissions economy. We've got an extract of climate-related risk, or a diagram. These are the physical risks, the transition risks that are outlined within the TCFD and also incorporated within AASB S2. So this gives us a framework on how we think and consider and assess climate-related risks. There's also in the TCFD an overview of climate-related opportunities. Again, it gives us a framework. Not all of them might exist in your business, but it's a framework on things to consider. So our approach on climate-related risk and opportunity assessment, you can see our approach on the left-hand side and the outcomes. At the end, we have an assessment report, usually around 60 pages, with all our research, academic references. We do executive and board education based on that validation, and we update the risk register of clients. If you want to look at how we do it in particular, we start with mapping the value chain. We get information requests up, we ask the client for questions, we do our own research across the value chain, we look at risk and opportunities, we have a draft report, a draft risk register, then together with the client we look at that inherent risk assessment and time horizons lining up with their risk management framework. We do a client workshop to validate that, we update the risk register, and finally we have a final report and a register. So this is quite an extensive process. That climate risk and opportunity assessment usually takes 6 to 8 weeks because there's a lot of to and fro, there's workshops, there's research required. Project 8 is where we look at conducting a scenario analysis. So you have to identify your climate risk and opportunities first, and only then can you move on to scenario analysis. So Ramona, this is where I hand over to you.
Thanks, Aletta. So as Aletta said, after the risks and opportunities have been identified and assessed, that's a key input into conducting a scenario analysis. The first point we wanted to raise in relation to this is that there is different types of a scenario analysis. And so for the purpose, for this project and the purpose of the disclosures, we're looking at scenario analysis to assess climate resilience. And to do this, we use exploratory scenarios. So we're looking at a path to a potential future outcome and exploring what that looks like and how those risks and opportunities may impact your business under these different potential futures. This is different to scenario analysis that's used to identify and assess climate risks. So an example would be stress testing, where you look at a very high warming scenario, maybe greater than 4 degrees, and see how a particular physical risk might eventuate under that scenario. So it's the exploratory scenario analysis that we're looking at for the climate resilience disclosures. So as I said, the specific climate resilience disclosures of the standard are in paragraph 22, and what we're looking to make disclosures about is the climate resilience of the entity's strategy and business model when taking into consideration the risks and opportunities. So a very specific type of scenario analysis is required for these disclosures. The unique situation in Australia is included in the Corporations Act, and so that's where the requirement to use a high warming scenario, so greater than 2.5 degrees, and a low global warming scenario limited to 1.5 degrees. So those requirements in the Corporations Act, and that it needs to be incorporated into the exploratory scenarios that you develop to inform the climate resilience disclosures. So the way that we go about that, we closely follow the guidance that the TCFD has released for scenario analysis. So going through this process where once the governance is in place, we look at the external environment and the risks and opportunities that you've identified, and then moving through the process to developing focal questions and the defining your time horizons, and then looking at the driving forces behind those different risks and opportunities to draft these narratives of those specific required scenarios, so the 1.5 degree and the 2.5 degree at a minimum. Then moving through the process, you look at quantifying some of those variables and assessing quality to finalize the scenarios, and then draw conclusions from there. From that, the strategic value can then be incorporated where potential strategy options and identifying metrics for monitoring future developments are steps that can be addressed once we have drawn the conclusions and done the analysis. And so it's really that analysis that informs the disclosures, but then can also inform strategy moving forward. So the scenarios that you develop, again, distinguishing between external scenario sources that at a global level, so climate goals where warming is limited to 1.5 degrees, you then need to take those global scenarios and refine them down to specific narratives for your organization to then explore these potential futures under those different scenarios that are required. As I said, we look at different external scenario sources to help inform that. And so some of the external sources we use and the specific scenarios that they have developed that can be useful in developing scenarios for your organization are the IPCC scenarios, so the SSP2-4.5, which aligns to the RCP 4.5 scenario for those of you that are aware of the previous scenarios, and then the low warming scenario, the 1.5 degree scenario, which doesn't have a previous scenario developed by the IPCC, so data can be quite limited on that one, but that is the only IPCC scenario that aligns with the 1.5 degree requirements in Australia. We also look at the NGFS scenarios, so a current policies and net zero scenario that align with those required scenarios in Australia. And also in some instances, the IEA scenarios are very informative for specific entities in specific sectors. And key to note for them, a recently released new scenario in the World Energy Outlook that was released in November last year. So the current policy scenario that is new aligns quite closely with the high warming scenario and is useful for that purpose as well. So I think over to Natalia to talk about the financial modelling.
Thank you, Ramona. So with the steps taken, as Ramona mentioned before, we can then move into financial modeling. We use the TCFD to assess the financial implications across the entity's financial position. And the financial impact is driven by the exposure to climate risks and opportunities, the entity's strategic response, and also the entity's appetite for seizing opportunities. So the standard requires an organization to assess these risks and opportunities both from a historical and forward-looking perspective. Therefore, we use a financial modeling assessment that is performed across different time horizons, and we consider at least 3 scenarios. One is your business as usual that considers today's policies and your current strategy, any expenditure associated with your strategy to limit transitional and physical risks. And then we move into scenario analysis that aligns with what Ramona was just saying. The 1.5 on net zero scenario explores mostly changes in carbon prices, or any other transitional risks from the energy transition or low carbon economy. And on the other hand, the high warming scenario explores mostly impacts on physical climate change, so impacts on your facilities, any expenditure or additional expenditure to limit these impacts or build resilience, physical resilience. And then finally, the way we approach this is building a model that aligns with your financial statements, first understanding what the model is supposed to answer based on the scenario analysis and the climate risk assessment. We co-build a model, which means we define what are the assumptions of the model, what information is in place, what external climate scenarios or data points are available, like NGFS, IEA, and so on. And finally, we have a handover session where we explain to the clients how to update the inputs in the future and update any other climate implications as science and regulation progress in the future. And yeah, I'll hand over to you, Alida. Thank you.
Thank you very much, Natalia, and thank you to Ramona as well. I just want to go back to this financial modeling. I think it's really important to understand that the resilience disclosures, which Ramona talked about, are the modeling around the scenarios, which is on the right-hand side of the slide, paragraph 22 of the standard. On the left-hand side, the business as usual disclosures are captured in paragraph 16 and 17, where they ask about what have you experienced, expenses, etc., during the current reporting period, and then also what do you anticipate over the short, medium, and long term. So on the left-hand side, your business as usual or your base case disclosures are, paragraph 16, 17, and then the right-hand side, your scenario analysis, paragraph 22, which is a resilience disclosure. But the financial modeling covers all of this, and they actually work hand in hand. And then finally, we get to project number 10, where we prepare the mandatory sustainability report. And I think here it's important to understand that once we get to the mandatory sustainability report, we have to consider materiality. And there's been some misconceptions around materiality. And that is that there's actually a two-step approach. There's a part A, where you look at your climate risk and opportunity assessment, and you don't apply materiality there. You consider prospects. You consider the risks and opportunities that could reasonably be expected to affect the entity's prospects. And what do we mean by prospects? Cash flows, access to finance, cost of capital over short, medium, long term. Nowhere there do we see the word materiality. It's all about prospects, could reasonably expected to impact prospects. And if it meets the cut, if we've got client related risk and opportunities that could reasonably be expected to impact prospects, we then consider the information in respect to those risk and opportunities, and then we consider whether that information is material or not, because there could be a lot of information, too much information. So materiality is applied in that part B. I have included a slide that looks at that. I call part A a prospects assessment, right? It's not a materiality assessment. So we want to identify risks and opportunities that could reasonably be expected to affect the entity's prospects. So that could reasonably be expected is an assessment of how likely it is that your prospects could be affected. So it's a likelihood assessment. And then when you get to prospects, it's cash flows, access to finance, cost of capital over short, medium, long term. Very important is this is a market perspective. If the market look at your business, what prospects, what risks and opportunities do they think would reasonably be expected to affect your prospects. So it's not just your view, it's what would the market expect. And if the reality is different, disclose why your reality is different to what they expect. So a materiality assessment, the IASB published a materiality assessment document for sustainability, which you can see on the right-hand side, the various steps. And it's aligned with the materiality document that we also use for financial statements, the same 4 steps. As I've said earlier in the presentation, we have prepared an illustrative sustainability report that you could use, and it should be read with your financial statements. The two go hand in hand, and that's what we do within our final step in the project. We bring together materiality together with the report. The prospect step will be considered when we do the climate risk and opportunity assessment. When we get to project stream 3, this is the strategic voluntary disclosures or voluntary stream. What I'm finding is a lot of group 1 clients are saying, we're doing all this work, all this effort for compliance purposes, but we want to get strategic commercial value out of it. We want to make sure we get access to capital or cheaper capital, debt and equity. We want to make sure we get access to markets, to customers, get access to people to work in our business. So there's a strategic reason too, and they want to explore that. Group 2 and Group 3 entities are starting to speak to us, and we're working with a number of them where they're saying, we thought this is a problem for 2027, 2028. But we can't get access to our customers if we don't have certain things in place. And we can't get access to capital without it. So there's definitely a push. So if you want to look at sustainability from a strategic perspective, the best way to do it is start with what do we have in place? What do our stakeholders need? And that we focus on stakeholder needs, because this is all voluntary. Then we commit to fill the gaps. If there's gaps between what we have and what they want, we measure and we could voluntarily report. And that will put you on a good journey towards mandatory reporting as well. Because I know your customers, your stakeholders will want your carbon footprint, they will want targets, and they will want progress against targets. So you tick project stream 1 at the same time. From a Q&A perspective, I know we've run over time, but people who have to leave early can watch the recording. From a Q&A perspective, I've had 6 questions come in before this webinar. And the one is around what are the current penalties under the safeguard mechanism? The second one is around discussions on TNFD and the expected timelines for when it will come into legislation. We've already discussed that earlier in the webinar. How to best prepare for assurance on climate disclosures and sustainability reporting. I think we've dealt with that by giving you a best practice roadmap. Claudia talked about what your auditor will be looking at from an audit perspective. But I think the roadmap, to have a roadmap and to maybe break it down into month by month or week by week, what you're going to do, and making sure you've got documentation of everything you do is my best advice. You know, ASIC always says, not documented, not done. The same applies to sustainability reporting. The question 4 is, does sustainability reporting apply to privately held entities in Australia who are SGEs? The requirement in Australia is, as I've said earlier, is based on size predominantly. And therefore, whether you are privately held or not, whether you're listed or not, doesn't matter. It's about size. It's looking at a combination of, if you meet 2 of the 3 criteria around revenue, gross assets, and number of employees, you could be subject to mandatory sustainability reporting. So there could be SGEs that are privately held that meet the size criteria and therefore are captured. So important to consider that. Then also, 5th question is similar. Are there any plans for not-for-profits to be added to this reporting? Just be very clear, not-for-profits are already added. If you are a not-for-profit and you're lodging financial statements with ASIC, remember that's the first question, is your entity lodging financial statements with ASIC? Many of our not-for-profit clients lodge financial statements with ASIC, so tick, they in. Then those not-for-profits have to look at the size criteria, whether they are group 1, 2, or 3. So not-for-profits are already in. If you're a not-for-profit not lodging with ASIC, or if you're a privately held company not lodging with ASIC, yes, then you're out. So the threshold question is the entity lodging financial statements with ASIC as required by Part 2M of the Corps Act? And then the last one is, what are the potential Australian market and reporting impacts of the Scope 2 proposed changes by the GHG protocol? So I'll come back to question 1 and 6. As we went through, I've addressed questions 2 to 5. So question 1 is talking about the safeguard mechanism. There's a link to the website where you can find out more about the safeguard mechanism, but it applies to facilities that emit more than 100,000 tons of carbon dioxide equivalent in a year. And it sets legislated limits known as baselines on the net greenhouse gas emissions of these covered safeguard facilities. In 23-24, there were 219 safeguard facilities, and so quite a bit of information available. Going to the penalties, on that same website, I found the following around civil penalties. So this is updated from time to time, and here they're saying the maximum civil penalty is set at 1 penalty unit per ton of excess emissions per year, and the infringement notice charged at 1/3 of that maximum civil penalty to an absolute maximum of 150,000 penalty units. Now, the last time there was a value assigned to penalty units were in November 24, and that was $330 per penalty unit. So you can do the calculation. If you've got the maximum penalty units of 150,000 at $330, we're talking about quite a big civil penalty. If we look at Scope 2, I think the key thing here is that it's around the location and market-based reporting methods. In Australia, under AASB S2, we're only required to report under the location-based. You can voluntarily report market-based as well. The central feature of this proposal is an hourly matching and deliverability requirement for market-based reporting. So if you're just doing location-based reporting for AASB S2, I don't think there will be an extensive impact on you. However, if you want to voluntarily do market-based reporting, you have to now look at hourly matching and deliverability in order to use the market-based reporting, and that will be very complicated. There's a lot of different methods approved. We are currently working through it and working on a comment letter on behalf of BDO Global. The other thing that's important, when I listened to the podcast by Sue Lloyd of the ISSB, she did say we shouldn't assume that these changes to Scope 2 will automatically be included in AASB S2 or IFRS S2. So they were very specific in IFRS S2 to say that IFRS S2 is based on the corporate value standard of the GHG protocol, just that one. All the other guidance, etc., can be considered, but they only mandate the corporate standard. And therefore, they could decide to not mandate this Scope 2 guidance. There is close cooperation between the two bodies. I'm sure they'll be looking at it, but she said it's not an automatic. So that was interesting to hear. I thought it's an automatic, to be honest. So how BDO can help? Our national partners, I'm in Melbourne, but I also am the national leader, so I work across the country. Kevin in Sydney, Tom in Brisbane, and Ashley in Perth. Ramona, Claudia, Natalia work with me, and we've got clients right across the country, from Perth, Brisbane, Sydney, everywhere. So please feel free to reach out to us. And the other way to stay connected is you can register and subscribe for our monthly Corporate Reporting Insights, which has IFRS accounting standards and sustainability information. But you can also subscribe for Sustainability Insights, which is only focusing on sustainability. So that's a way to stay connected. Please feel free to reach out if we can assist you. So Ramona and Claudia and Natalia, thank you very much for joining me today. I'm sure the attendees was happy to hear a non-South African accent for a part of the webinar. So thank you very much for joining, and we'll see you again next month. And thank you all our attendees for joining us today. We appreciate your support.
Thank you.